Good morning. It's Thursday, the 26th of June, and this is Govindraj Ethiraj broadcasting and streaming weekdays, usually from Mumbai, India's financial capital, but in transit right now. Our top stories and themes in a somewhat shorter edition of the core report. The stock markets gained for a second day on the Israel-Iran truce. Oil prices stayed down. How mutual fund investors are diversifying their holdings on the back of record systematic investment plans or regular investments. 1 in 4 Indians say they only use mobile phones to consume media content.
This is a core report with Govindraj Ethiraj.
The markets sustain another day. Well, before we come to the markets, remember there is a tariff threat that's looming even as we've been following the news of the war and the latest news of a ceasefire between Iran and Israel, which obviously boosted markets. But remember, the tariff agenda is at this point unfinished. Trump is up against a self-imposed 4th of July target to pass his tax and spending bill, and he's 2 weeks out from the July 9th expiration of the global tariff pause that hit the economy in April when he first introduced a raft of levies, according to Bloomberg. Back home, domestic markets held their gains for a second straight session. Reliance Industries led the charge on a day that saw the Sensex closing 700 points up at 82,755, and the Nifty 50 was up 200 points to 25,244. The broader markets were also strong. The Nifty mid-cap and the Nifty small-cap indices were up 0.4% and 1.5% each. Oil prices are now just under $68 a barrel. The rupee fell, though, on Wednesday, a day after posting the best session of the year. The currency closed 12 paise lower at 86 rupees 9 paise after closing at 85 rupees 97 paise against the dollar the previous day, according to Bloomberg. On Tuesday, the rupee had posted its best one-day gains since May 23rd. Speaking of currencies, the British pound, if you've been following it at all, is hovering at its highest level in more than 3 years and was trading around the $1.36 mark on Wednesday. So far this year, the pound has gone up 8.7% against the US dollar, according to figures from CNBC. Meanwhile, gold is giving up some of its safe haven appeal with the truce agreement between Israel and Iran. It steadied on Wednesday after falling in the previous session thanks to that improved risk appetite. And attention is now shifting to upcoming US economic data. Spot gold was not much changed at $3,325 per ounce on Wednesday. On Tuesday, gold prices had hit their lowest in over 2 weeks. Sustained mutual fund investments. So there are a few reasons behind the market's overall steady behavior. Some are obviously macroeconomic, as we've discussed on the show, but some are more microeconomic and have to do with domestic flows as well. While spikes have come, including most recently because of foreign institutional investors buying actively, the floor or the high base in many ways is thanks to domestic investors, including mutual fund investors. Last month saw a record 26,688 crore rupees invested in systematic investment plans or SIPs of mutual funds. That's almost 27,000 crore rupees. Moreover, that monthly figure was higher than the 20,000 crore mark for a 10th consecutive month and is now touching about 85 million accounts. So the mutual fund industry's assets under management is about 72 lakh crore rupees, which is up from about 70 lakh crore rupees in April. This also has to be seen in another context, which is of where investments are going from Indian households. So share of mutual fund assets under management, primarily in equity schemes, is now 31% or more than 30% of bank deposits from around 13% 10 years ago. Now, this is, of course, good in a way because it shows that investors are diversifying and expanding their risk profile. But I guess there is also a concern if investors put too much money in only equities. Investors are also spreading their wings, speaking of which, to categories like hybrid, arbitrage, equity savings, and balanced advantage, as we will shortly find out, which also suggests that many investors are fairly proactive even in the mutual fund ecosystem. I reached out to Vikas Jain, co-founder and chief investment officer of Multipl, a SEBI-registered fintech platform that directs investors towards mutual funds. And I began by asking him how he was seeing the latest trends and his outlook.
So in terms of the flows, what we are noticing is there has been definitely a shift, not just in terms of a decline in the net inflows, but also in terms of the categories, right, where the flows are moving and how, different categories are behaving. Also, I'll share a bit later about how it has been on our platform. But firstly, generally about the industry, the valuations were certainly a concern, especially in certain segments like small and mid cap. A shakeout was necessary, so which is in a way good because it helps sustain the longer term trend. And what has happened is the inflows have fallen more sharply for smaller and mid cap segments. And I mean, of course, the overall inflows have gone down, but the impact has been much less when you look at categories like multi cap or flexi cap or multi asset, because the risk is kind of diversified there across segments rather than a specific segment which is overvalued or overheated. And that is what I think has been reflected in terms of the flows movement as well. Also, in terms of hybrid funds, slowly the hybrid funds are picking up, which again I think is a good thing because at current rich market valuations, it is good for people to be invested in funds which are less volatile, which helps them sustain their journey through this mutual fund inflows which are coming in to achieve their goals. Also, one major shift I would say has happened is the SIP flows. They have remained strong, and that is a major behavior change, not just in the recent times, but which has been happening over the years, wherein people who are invested in SIPs are not really seeing a red in their portfolio. There is a decline for sure based on market movements and the recent choppiness. But over a longer term, because they have been investing continuously over a period of time, they have not seen a red in their portfolio. Maybe it's just a decrease from the values they saw earlier, but at least not a red in terms of a drawdown of capital. Because if you look at it, in terms of the historical experience of retail investors, whether it was, say, the 2007-8 boom before the global financial crisis or later boom periods also in the early part of the last decade, retail would come in at the peak, invest in lump sum, then after a few months see a drawdown of 20, 30, 40%, and then think that, okay, this is just a speculative market and move out. But today, when they are investing in SIPs, because of the average behavior of the SIP, which by nature, right, by default, SIP will give average returns over the cycle, people are not seeing that kind of a sharp drawdown in their capital and also not a red in terms of their portfolio because they have been investing over a period of time. Yes, some investors who would have started investing in, say, September, October of last year at peak, and especially in segments like small or mid cap, they might be jittery and they might be moving out. But a large part of them are not. And that is why we are seeing that SIP flows, while they went down marginally for a couple of months, again in May, we saw record inflows, which we believe will continue. Now, coming to the behavior on our platform, we call it spend vesting. Multipl is all about spend vesting, wherein people invest for their spends. Of course, they can save for their needs, wants, and long term savings as well. But the primary hook for Multipl is that people come in, save for their aspirational goals like jewelry, gadgets, vacation, shopping, etc. And here we have been very careful over the last couple of years in terms of giving allocation only to safer funds, especially if the goal horizon is less than 1 year. We have been giving only debt funds, especially liquid or maybe ultra short or at the most low duration, depending on the time horizon of the goal. And therefore, we haven't really seen any impact in terms of outflows or, a drawdown in terms of the SIP flows. Of course, some people had their long-term goals as well on Multipl, and there was some panic, but we were able to, counsel them and guide them that this is something you are saving for the next 5 years, 10 years, 15 years. And you don't need to panic with these volatile movements because that is part and parcel of the equity investment. And we have been able to kind of stem the flows. We only see SIPs increasing, especially people have started moving to SIPs even for their shorter term goals because bank savings rates are now 2.5%, 2.75%. As you saw recently, SBI cut it to 2.5%. Even in FD or RD, if you're doing it for 3 to 6 months, the interest rates are pretty low, just about 3 to 5%. So we are seeing that the younger generation especially is wanting to move to an asset class or an investment where they can get higher returns than the bank, and which is where mutual funds like liquid or ultra short or even hybrid, considering the goal horizon, if it's a 2 to 3 year goal horizon, maybe a hybrid fund also. So we are seeing the movement, the shift, especially in the younger generation who are moving towards these alternative options for savings bank account. And they also want to invest in equities for the long term. So the awareness definitely is increasing, and that is something that will help the flows continue with some minor hiccups at the most, especially for SIP. Lump sum, yes, there could be some panic withdrawals, but again, as people see that market stabilize, they would come back in.
Right. So, quick question here. When you see investors staying on in the market, particularly mutual funds via SIPs, so how much would you say is because of inertia and how much because they've strategically decided to stay on for the long term, which is what the whole proposition is?
See, definitely some bit of it would be inertia. I don't deny that because that is the same in case of savings bank, right? That's why people don't move money from savings bank. But some bit of inertia might be there, but a large part of understanding is also there. And people are, in fact, some of them are also stepping up SIPs, right? Thinking that, okay, valuations are lower today, why not capitalize on it and step up the SIP? So there is some active movement as well. It is not just inertia when it comes to, the SIPs because people actively track. Unlike a savings bank account where you don't maybe check the balance once in a while, but you're not really tracking the return on it. But when it comes to mutual funds, people are actually tracking returns. Even if it is a debt fund or a hybrid fund, people are tracking returns. So there would be active movement either ways. Like, even holding on is an active decision, right? And that is reflected in the data also. So if you look at the Amphi data, people holding that mutual funds for more than a year, the percentage has been gradually increasing. And people holding it for more than 5 years, that also has almost doubled in the last 4-5 years. Like earlier, it was, I think, some single digits, 5-6% people were holding it for more than 5 years. And today it is, I think, about 15% or something. So definitely there is a shift in terms of not just inertia, but people actually realizing the value over time. Again, the huge shift has been because of the SIP rather than lump sum, which was being done earlier. Because in SIP, you don't get that jor ka jhatka, which you used to get in lump sum. You don't get that in SIP, right? Where you suddenly see a 30-40% capital drawdown. You don't see that because it is already averaging out over time.
Right. So you've been an equity research analyst, I'm assuming, facing institutional investors, and you used to work for Goldman Sachs. So today, if you look at the behavior of, let's say, retail investors versus the kind you used to deal with in your last job, I know it was a while ago, but how far do you think today's retail investor class is from, let's say, more longer term institutional investors? I'm not saying everyone has to go there, but what's the gap like in India today versus maybe other markets? And where does it need to go in your sense?
Oh, see, certainly there is a huge gap and a lot of education is required. And that is where, not just us, but also regulator and media have a role to play. Because unfortunately, India, especially the retail market, has been a very product and sales oriented market. Unlike, advisor or solution oriented market, which we see in some of the developed countries. That clearly reflects in the behavior also, right? Because most of the mutual fund distributors are distributing only equity products, even when it comes to mutual funds. And the commissions are the drive what is being distributed. That is why retail has almost 88% of the investment in equity and just about 12% in debt. Unlike institutional investors in India, where you will see the mix is more balanced. In fact, there is a good balance of debt and equity when it comes to institutional investment in India. But yeah, the same does not reflect in retail because a large part of the debt portion is lying in efficient instruments like savings bank or RDs. When it comes to equity also, the behavior is definitely changing, but still it is a long way to go. Because the funny thing is in India, people invest in FD for 20 years. Nobody makes a 20-year FD, but they make a 1-year FD and keep rolling it over for 20 years. And in equity, they want to invest for 6 months and double the money. But that behavior is changing because of SIP, fortunately. So the behavior shift is happening. It is slow. It has to accelerate. And I think it will because the younger generation has greater access to information, or at least they are more tech savvy. They are more willing to find out more about things from different sources. So the shift is happening. It's a bit slow. I would have wanted it to be much faster, but it is happening for sure.
Right. Thank you so much for joining me, Vikas.
No problem. Thanks a lot, Rohit. Good talking to you.
And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. The phone is the TV. Nearly 1 in 4 Indians have said in a survey they use only mobile phones to consume media content. One reason is that television sets are unaffordable for many, and the number of users who use digital channels only has now risen to 23% in the March quarter of 2025, according to a Bloomberg report quoting market research firm Kantar Media's Compass report this week, which surveys about 87,000 Indians. Now, that 23% has to be contrasted with the 15% of people only using digital channels in 2023 or just 2 years ago. A Kantar Insight Division official said that the trend is skewed towards lower income groups and rural users, particularly men. But many people who are now consuming digital content on mobile phones were media dark, he said, as television sets and multiple OTT subscriptions are costly. India is back in space. India's Subhanshu Shukla shot into space with 3 other crew members to the International Space Station as part of a commercial mission by Axiom Space on Wednesday, 41 years after astronaut Rakesh Sharma's spaceflight. The other crew include NASA retiree turned private astronaut Peggy Whitson, who was launched on the 5th flight to orbit of her career, and crew from Poland and Hungary. The crew lifted off from NASA's Kennedy Space Center in Cape Canaveral, Florida at about 2:30 a.m. Eastern Time on Wednesday, beginning the latest mission organized by Axiom Space in partnership with Elon Musk's rocket venture SpaceX, according to Reuters. Axiom 4's autonomously operated Crew Dragon was expected to reach the ISS after a flight of about 28 hours, and then it would dock with the outpost in an orbit about 250 miles or 400 kilometers above Earth. The astronauts are expected to spend about 14 days aboard the space station conducting microgravity research. The Axiom 4 participation by Shukla, who's also an Indian Air Force pilot, is seen by India's own space program as a kind of precursor to the debut Crude mission of its Gaganyaan orbital spacecraft planned for 2027, says Reuters. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.